Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to our question of the week for this week, November 3rd, 2022. The question this week is kind of a unique question. This question was actually asked on the Dave Ramsey show by Chris in Fort Worth, and we're going to answer it again. And not that we think Dave answered it wrong. That is, we think he answered it 100% the way we would, and we would have expected him to. We're going to answer it with a little more flavor, a little more charts to help reinforce Dave's answer he gave to Chris in Fort Worth. Now, Chris in Fort Worth said, Dave, I've got the 4 categories of investing: growth, growth and income, aggressive growth, international. But I'm looking at the returns of the international funds, and I'm just wondering, is there truly a benefit to diversify internationally when the returns have been so much lower than what we see in the U.S.? And Dave answered that question the exact way we would expect him to. He went back to when he started the show with a financial advisor at the time, and they really looked at analyzing the different allocations you could make this way, that way, and every way to the moon. And having that international exposure along with the aggressive growth, and the growth in income was the best way to kind of be a master of the middle. Have something that's in the best, something that's in the worst, and keep your returns in the middle, which the middle has been very good for investors over the last 30 years or so. So that's true, and that type of investing is certainly going to see cycles, meaning that there's going to be periods of time where you're happy with a certain type of investment and certain periods of time that you're unhappy with a certain type of investment. And of course, unless you have that crystal ball to say, well, aggressive growth is going to be the best this year, or growth is going to be the best this year, or international is going to be the best this year, then you're better off to be that master of the middle. That's what the millionaire next door does, is he or she is the master of the middle. They don't need the best. They don't want the worst. They want to sit in the middle of that. So look at this chart on your screen. This chart will help you see it a little bit. What you're seeing on this chart is the returns of all kinds of different stocks over the last 20 years. Okay? And the color I want you to focus your eyes on is the darker gray that we've circled for you there, the INTL. Now, all these other colors are growth stocks or growth and income. They're aggressive growth. For the sake of the length of this video, I won't describe each one of those or circle each one of those. But I have circled the international. And what you see with the international is there are periods of time where it does underperform. It's not the best performer. But there are periods of time where it is the best performer. Now, the hard thing for investors today, either you weren't around or you just may not remember the last time that international has been the best performer. But look at the years prior to the 2008 financial crisis. 2004, international was the 4th best performer. In 2005, it was the 2nd best performer. In 2006, it was the 2nd best performer. Each of those 3 years, it only lagged real estate, which we would argue most people don't have real estate in their portfolio anyway. So it was the best performer in terms of stock market allocations over that 3-year period. In 2007, it was the 3rd best performer. And then since 2008, it's gone on a lag where it's not performed as well relative to U.S. stocks. 2017, it had a pretty good year. And 2020, it sat in the middle of most of the returns. So again, it's not that it's been a terrible performer. It's just been out of favor. Now, here's I'm no economist, but here's an economic thought for you. One thing that we've seen happen over the last 10 to 15 years is a massive push towards globalization, meaning taking our economy and pushing jobs, pushing work, pushing things that we don't want to do outside of the U.S. And of course, that has helped other economies lift themselves out of poverty and improve. But it's certainly helped the U.S. economy a whole lot more there, because we've been able to reinvest in a lot of the higher paying technology type of jobs. But what you're starting to see now is, in many different ways, is that globalization is kind of falling apart. We're seeing that partly because of the Russia-Ukraine war. Germany is really getting burned, and a lot of Europe, because they outsourced a lot of their energy needs to Russia. And when you can't produce it yourself and Russia is not going to send it to you anymore, that creates major stress on your supply chain. We in the U.S. are dealing with this because of our semiconductor shortage, those chips we need to run, and it's the basic chips like what we put in cars and phones, and the more advanced chips like what Taiwan Semiconductor creates. And so you're starting to see that get a little more brought back to the U.S. with what Intel's doing in Columbus, Ohio, down in the Southwest. Taiwan Semiconductor is building a plant down there. So all that to say that with a breakdown of globalization, are we going back to a pre-2008 economy? Perhaps. That's something we don't know, but that's a case for international right now, international investing there that may not allow the U.S. to grow as fast as we did over the last 10 to 15 years and might make a case for international investing. Here's the other thing about international investing. This is where selection of the manager is very important, okay? Selection of the manager, meaning that when you look at the returns of international funds, if I just went to our friends at the largest index producer in the world that starts with a V, I won't say their name, but oh, nope, I won't do it. Their returns for their international fund, which is an index fund, only produced 3.9% over the last 10 years. So not a strong argument, as Chris made, to investing internationally. But you look at the four basic funds that we use for our clients from an international perspective, and they range from 9.43% a year over the last 10 years, 8.05% a year over the last 10 years, 7.73% a year over the last 10 years, and 4.99% a year over the last 10 years. Again, the index, the benchmark, the big index provider was 3.9%. So manager selection really makes sense here. Remember, if you get a greater than 7% return, that doubles your money over that 10-year period of time. So we do believe in international investing. We think it's something that should be part of your portfolio. And Chris, you're asking the right question because you just want to make sure there's justification and validation for why you're doing this. And again, what you've seen over the last few years is just a situation where international has not performed well. But we'd be foolish to assume that that's the scenario in the case for the next 10 years or 15 years. The market has a great way of reverting to the mean. The best becomes the worst becomes the best. Maybe we'll see that, maybe we won't. But you can be for sure our allocations will continue to maintain that 25% international. And oh, by the way, prior to this, you might say, some people argue, Dave's strategy is too basic. It's too simple. No. Dave's strategy is very easy to understand. It's not too basic. It's not too simple. It's based on the advisor to execute it with complexity if you need to. When I worked for a very large bank in their private banking division, which was their largest clients at the bank, guess what we did? We invested growth and income, aggressive growth, international. We didn't call it that. We made it a lot more complicated. We used $10 words to explain $2 concepts. Dave doesn't do that, which is what's great. So the strategy is great. It works well, in our opinion. Dave's teaching the right way, in our opinion, on the way you should be investing. And that international piece is an important component. If you have any questions about how your portfolio might line up to the 25, 25, 25, 25 allocations that Dave recommends, click on the schedule a meeting button in the notes of this video so that you can schedule a meeting with any of our advisors, as well as you can click on the blog section to read any of the great articles that our financial advisors and our financial coach have written on money saving, budgeting, or financial planning topics that you might want to learn about. As always, we appreciate it when you hit that like button. That like button helps algorithms within Google and YouTube push us higher up so that we can give more content that helps people live and give like no one else. Thanks so much. We'll see you next week.